Even go.
There we go.
Who knows? Hey, everybody. Welcome to another episode of Ask Me Anything with the BYOB team here. We're going to go ahead and get those questions in here in the chat box. Go ahead and get those in the chat box, and we'll see you guys here in 14 seconds.
Kevin, I lost him again.
I hear you, Joe.
All right. Welcome, everybody. So we're going to go ahead and go around the horn here in just a moment and do a bunch of introductions.
Bye.
Joe's going to be talking himself because he can't hear anybody. So
he's not crazy, folks. He's not crazy. He's just having a moment. He's having a moment today. He comes back. We'll welcome him back.
Yeah.
Technical difficulties.
Joe's having some technical difficulties. So go ahead. Once again, get those in the chat box, those questions here. So now, for those of you that are new to this, so I want you to go ahead and put a 1 or put a yes or put something in the chat box if you're new to the Money Multiplier, to Be Your Own Bank, and to our campfire, or if this is your first time on an episode of Ask Me Anything. I want to see how many new people we have. I know we're just getting people coming into the room here. So for those of you that are new, just keep this in mind. So we do quite a few live events here at the BYOB team. We have 6 live events a week. We have one on Monday. We've got Take Back Control on Tuesday. We've got 3 events today on Wednesday. So this is our last event. We had 2 already today. And then, of course, we have our Thursday event as well. So if you guys want some links to those, we'll put a link here in the chat box to our live events here in just a bit. But once again, ask me anything here. This is for you guys to ask questions about, infinite banking, about money, about, even HELOCs or all-in-ones, anything money or investment related. Go ahead and ask those questions here. We are not financial advisors, though, so do keep that in mind. We are not providing financial advice. This is for information and educational purposes only. But let's go ahead and get those in the chat box, and we'll go ahead and go around the horn here. So I'm Brian Fouts up here in North Idaho, and I cannot believe that I'm saying this, but it feels like springtime here. It's about a month early, I'll be honest, but the snow is melting, and it is very strange. I'm not sure quite how to take it, but yeah, it's kind of crazy. So, but with that, I'll hand it over to Ms. Tess.
Hey, I'm Tess Hulak, and I am actually just about a half hour outside of Detroit, and we do not have any snow on the grass right now either. But usually in the morning we have snow, and then it's gone by noontime. Glad to be here. I can't wait to hear what your questions are. Love having you around this campfire, and hope you come back often. Over to you, Kevin.
Hey, what's up, guys? Thanks, Tess. Upstate New Yorker, similar to Joe and Chris. Looking to help anybody and everybody regarding, like Brian said, HELOCs to infinite banking, to any money questions, solving your problem, having some fun doing it, right? That's what it's all about, having some fun once you start figuring things out, learning something new, getting into a mindset that you've never heard of, or doing different things that you've ever done. And it's super exciting once you kind of understand it, you educate yourself and get out of doing what traditional information has been teaching you and stuff that you haven't learned in school, or maybe even from your parents, right? So get on board, get around the campfire, and fire away some more questions in the comments or email them, right? That's a great way to do it too. So I guess I will go downstairs to Jason Sipple.
Hey, thank you, Kevin. Hello, everybody. Welcome to another wonderful Wednesday edition of Ask Us Anything. Maybe we'll ask you questions if you don't start asking us questions. That might happen. I'm here in the city, beautiful as always. Grateful to be here. Looking forward to hanging out with this crowd and having some fun. So over to the man from Hopkinsville, Kentucky. So let us know.
That's right. Jason, you almost nailed it. Yes, Glennis Nolt here from Hopkinsville, Kentucky. Happy to be here, help with answering any questions and provide insights that I can. Here's something I want to say or share quickly of what I was doing last night. So I kind of did something new. We had 2 cheap family vans that broke down, so they're actually scrapped now. So all of a sudden we had nothing to drive, and so I'm borrowing my brother-in-law's truck. I'm going 2 hours out to pick up a good deal on a van. What I did is I taught myself from YouTube and the Googles and the Reddit threads and stuff how to take out the little keyhole itself, the little tumbler that the key goes into with all its little pins. I taught myself how to take that out and fix it so that this car would even start that this Facebook Marketplace seller had. So I did that and picked up a really good deal out of the work I did there. But I am tired. I didn't go to bed till 3 this morning, I think, after I came back with that deal, that steal of a deal. So that's something new and cool that I did that I'm actually proud of. So that's it for me. Go ahead, Joe.
That's cool, Dennis. I wouldn't even know where to start, but that's awesome.
I didn't either. I just started the Google and the YouTube. I spent a couple hours and oh yeah.
That's so cool. So I'm Joe. I'm up in Buffalo, about an hour away from Kevin, and here to answer your questions in regards to real estate and HELOCs and everything else that these guys mentioned. Anything to do with money, strategy sessions. Education is 95%, 5% is you implementing it. Learning stuff new and changing your mind. That's what we're here to do. So get your questions in and let's go.
Let's dive on into it. So we got a few questions, but as always, get those questions in. So this one's from Freedom Dave McTigga, whatever. So good afternoon. Have you heard of HEI, which is a home equity investment, as an alternative to a HELOC, which is a home equity line of credit? One company called it Home Tap, and I came across others just looking for your opinion as an alternative to a HELOC. So just for so for those of you that are not familiar with what an HEI is, it's a home equity investment is what that stands for. And the way those things work is a company gives you a lump sum of cash today in exchange for a percentage of your future value of your home. So there's typically, if I understand this correctly, I've never done one, never been involved in them, but I've done the research years ago. No monthly payments. There's no interest rate, by the way. You just pay that, whatever that amount is, 10, 20, 30 years down the road. So it's typically the amount plus a percentage, if I remember correctly. So it's definitely different than a HELOC, which is a revolving line that you can use or not use. A HEI, it's not really considered a loan, by the way. It's just kind of weird. But you get a lump sum, but that's it. You're done. It's not like a revolving line where you can use it over and over and over again. So, Joe, I'll pass it off to you, obviously, on this one. But it depends on what you're trying to do and accomplish. In our world, an HEI, and in my opinion, would never make a lot of sense. But
what you're doing is you're giving up your equity to an investor to make money on you. It, in my opinion, would be the very, very last option that you have. You're actually selling your house, still living in it. Mm-hmm. And it's going to be a greater, much greater number in that 20 to 30 years. And usually this happens to old people. It's like a reverse mortgage, more or less. And they'll die in the home and still
people like you, Joe.
I'm sorry?
You said old people.
I'm getting there. And then so now somebody, grandma, grandpa, mom, dad, whatever, they're living in this house, and this house is worth, $200,000, but $100,000 is already given away to another investor. And it's more or less most of the time the family just says never mind and just walks away. So as I say, just make sure you know what you're getting into and check all your all the paperwork and everything. And in my opinion, it probably would be the last option.
Yeah. And I've seen those things in conjunction with reverse mortgages for elderly people that have equity but don't really know what to do with it, as a way to basically survive in retirement, which is unfortunate, by the way. So yeah, I've heard of those before. But who here on this group is over the age of 50? So three yes, 3 no. Okay, there we go. Not yet. Yeah, I got a few to go.
Who in this group is over the age of 60?
We'll delete that part.
I'm not there yet.
Yep.
Proud of it.
And she's still infinite banking.
No, Joe was born the same year I am. I just give him a hard time.
Yeah, I know.
Well, cool. All right, let's get into some other questions here. So, L-Bell or I-Bell, but I think it's L-Bell. So, what are my options to get a line of credit from a housing? So I think you mean your own house that is paid off. Well, that's Pretty simple, right, Joe?
Go to, yeah,
That's
Joe to Joe.
that's even easier than a first lien. So
Because
if
it
you
is a
have a
first lien.
house, it technically automatically turns into one. If you have a house and there's no mortgage, you would technically qualify for a second lien. So you would go into your credit union or your bank and you would ask them for a HELOC. They'll go up to 80% or 85%, sometimes even more, depending on what the house is. You have to qualify for your income for to pay that amount, just like you did with your mortgage. But it automatically turns into a first lien because it's a second lien and there's no other lien on the house. 9 out of 10 times, there are no closing costs associated with a second lien, depending on the bank that you're dealing with. So that is a great option to utilize the equity in your house and put it to work, have a revolving line of credit, and still be able to use it.
Yeah. And Joe, I'll mention something. So we use a certain bank for a lot of these kinds of things. And one of the requirements, Joe, correct me if I'm wrong here, is reportable income on your tax return.
Mm-hmm.
Correct? And what is it?
Yep. W-2, if you have a W-2, they're looking for 2 years of taxes of your 1040s, 2 months of paychecks. When you're talking W-2, if you switch jobs and it's in the same kind of career, they'll consider that as long as there's 2 years on the 1040. If you have 1099, now you have to have 2 years of self-employment, and you're going to get the average taken between both of the 1040s. If the first year is greater than the second year, they're going to do an average. If it's the first one is lower than the second one, then they're able to use the second one. So it just depends on how the underwriter is going to be judging everything also.
Want me to throw you for a loop?
Sure.
So I was always waiting the 2 years to get a HELOC on my property. So, but guess what? As we always say here with this group, if you have questions or are thinking about infinite banking, but maybe not ready yet, it can still be a good option to have a conversation or come here and ask questions because you don't know what you don't know. That was me. So I talked to CM, those guys over there, and I don't have any W-2. I haven't had W-2 for over 10 years, I believe. And I have not had reportable positive income tax in over 6. So in my opinion, I thought HELOC is out the window until you have reportable income on your tax return. That's incorrect, I found out.
Unless you're going to do a bank statement loan.
Correct. So seeing they're starting to do those now for a HELOC. So it's the new thing that came out about. I found this out just over 30 days ago. It's a new program they're rolling out. So I'm one of the test eggs or test the subjects for it right now.
I got a mortgage 4 years ago by doing the same thing.
Well, this one is for all-in-ones. It can be an all-in-one or a second lien. And so they're doing a thing where I don't know how it's going to work out yet, but so I'm going through that process with them right now, and it's pretty interesting. It's a bit different for sure. So it changes the percentages of what you can qualify for, though. So I think it's 75 or 80% now. But yeah, so I'll Greg or how it goes with Greg and Harrison over there. But it's pretty interesting.
Yeah, that's exciting, right? And it's exciting too that's huge, right? That's a huge thing. And then it's also huge that iBell, right? He's got a 1 in there saying obviously he's a first timer, right? So that's pretty sweet. Thanks for obviously joining us. Get around the campfire. You're going to learn lots. And when you're talking about your house is paid off, I mean, boom, you're in a great opportunity. That's a great place to be. A lot of people can't say that. So keep coming back, getting those questions answered, and reach out to somebody because that's definitely you're in a good spot right there. So congrats.
And then Elbel, just keep in mind that when it comes to HELOCs, I don't know what the percentage is, Joe, you probably know, but there's a certain percentage of them out there that do not do what we're talking about with when it comes to HELOCs.
There are a lot of them, and be careful when you go in because they're going to say it's a HE loan instead of a HELOC. You don't want a closed end. You want an adjustable rate. You want a revolving line of credit. You want to be able to deposit money on Monday, take it out on Tuesday, put it back in on Wednesday, take it out on Thursday. You want to have the ability to do it. You don't want to have a limit of, you can only take out $1,000 at a time, or every time you take a draw, it's going to be a penalty or a fee. You don't want any of that. So
Mhm.
Just make sure that it checks all the boxes and it's, correct.
Yeah, and then also, so I mean, so Elbel, so there's about 3 banks I believe that we have personally have experience with, or our clients do that we do recommend. We don't have any say in those banks; or not part of them. But just keep that in mind. You can always reach out to us, and we can put you in touch directly with the people at those banks that you want to talk to.
Yeah,
'Cause
that
we can
we've
say-
used, right? Anything that we're in, just for this piece of stuff, since we're not talking about banking, we're not giving financial advice, we're not giving any of those things. We're just sharing our story of what we've done. Brian's super excited. You just heard doing something he didn't think was possible. Joe's done this paid off his home. How many times, Joe? It was 5 last time I heard you. How many
10.
10
now?
times. 10.
10 times now. 10 times, right? I'm got a first lien HELOC finally. I couldn't get it at first because I did transition out of corporate America. And when I applied, I didn't have the 2 years, and I wasn't 2 years yet into being an entrepreneur. So, I got to go through the process and get rejected until that. So we're just sharing. The point is we're just sharing what we've done and what's worked for us, and we can share that information with you as well. So
Yeah, and he says right here, or Elbel, he, her, he, she. That's the problem we run into. They're offering loans, not lines of credit. Yeah, you've got to be very careful about that, because there are things called HELOC loans. If you hear that term and a bank says that in the same sentence, HELOC loan together, run away.
But I don't understand why. There's no mortgage on the house. And so they just want to put you in amortization. You want a revolving line of credit. Yeah. You want a HELOC, a home equity line of credit.
And
it's kind of like banking, right? It's kind of like banking, and what we're talking about here with infinite banking. If you go to some of the mutuals, maybe some of the captive agents, and tell them that you want to do this, they're going to tell you that they know what it is, and they're going to tell you that they know how to do it. And it's very similar with what we're talking about with HELOC. I think, Joe, since I've heard you talk about this, I'm aware of 3 banks that I've heard you mention that do this, maybe 4. So it's similar where not every mutual company is. So point being, make sure you know what you want. And if you ask for it and they don't have it, don't let them sell you what they need you to do to fit their system that doesn't fit you.
Yep.
Yeah.
If you go to the bank and you get the sheet, you can call me up. I'll go over all the specs with you just to make sure that it is correct. So,
and just keep in mind the big box banks, as I call them, like the Chases, the Wells Fargos, they're very challenging to do this kind of stuff with, because they have their big way of doing stuff. They're more about volume, not being more one-on-one. So the banks that we're talking about, like, we're talking to the people at the bank that run the bank, that are responsible for it. It's so it's very different. Keep that in mind. And then, Lisa, you're also saying that your second policy is paid for. I want to leverage the equity and to pay off my primary property. That's actually, I love that. That's actually a great way to utilize a HELOC with velocity banking, and yeah, I love it.
that's how I started.
Yeah,
that's awesome.
And she mentions here, retired last year, 53, no debt other than primary residence. So if you retired last year, then definitely one of the things that we're going to be talking about, and the bank will be talking to you about, is your income now. If you retired, what's the income? Because obviously you have to have a certain amount to qualify for a certain amount of a HELOC. But it sounds like you probably already have been talking to banks, so you probably qualify, just from what it sounds like. Okay, that was a good one, though. Good question there.
Yeah, that's a great question. And then I just want to add something funny. You guys were talking about HELOCs, HELoans. Well, in June, He-Man is coming out. It's a new movie.
Wait, so that's like a cartoon that was made into a really bad movie that was hilarious, now being remade into probably another bad movie.
Absolutely. Super fun and entertaining, right?
Yeah, I think I'm excited about this movie too, Kev. So
yeah, if you haven't seen the original He-Man, the movie, oh my gosh, go watch that. It is hilarious. It's Vince, what's that, Lundgren?
Lundgren, yeah.
That's hilarious. All right. Already went to that one. All right, so let's go through Pizzarella's questions here. Hey, all, if a portion from a first lien HELOC is used for a down payment towards a second home, how would you still use the one pot system, assuming the second home is also bought with first lien?
You got to pick one or the other, perform velocity banking on it, and then just pay down the other one just with the regular interest until you achieve the goal of the one, and then you can fill up the other one.
It depends on what financing you use for the second home. I mean, Joe, would it make sense ever here to have a HELOC on another property, get a second home with a mortgage, and then use the HELOC to pay the mortgage off? Then
it's all math. So it just depends on how much is the rent, what is the cash flow, what are the extras, what is the overhead, how much is the money coming in, what is the cash flow. It's everything. I mean, when I talk to people, I'm in the Goodyear blimp looking down in the stadium. I have to see everything that's going on. I have to figure out, it's not going to be the same for everybody. So it's not just a cut and dry answer.
Yeah. Okay, makes sense. So that's what I kind of was hoping, but so obviously, there's some math to work through, but that's the cool thing. I was actually having a call with a client today about the vault and those kind of things, and they were very nervous about infinite banking. But once they saw the numbers and saw it, they got super excited, because now you can actually see what is going to happen. You're not guessing at the numbers. You're not saying, okay, if I do this, it might come out this way. You're seeing the actual math, and when it's in your favor, it's awesome. And so they got super excited. So kind of the same thing here. It's get the theory down, get the strategy down, and then once you kind of have an idea, then do the math on it and see if it still makes sense. Because I love that though. I want to bring up Craig's question, because I know you were on on Wednesday, or both Wednesday, I think it was, or WTF, I don't remember, both today. So Brian, for a bank statement loan, are you considered rural? I had a lender tell me I couldn't because I was rural. I am super country, so I'm way out in the forest. I'm up. I don't have any neighbors. I'm very, very rural. That never came up for me. And this was, just being very clear here, CMG Bank. So CMG Financial is the bank. Yeah, that didn't really come up. And by the way, Joe, I didn't know this, but Greg actually lives about an hour from me.
Oh, really?
Yeah, I had no idea. So we started talking, and I saw when he called me, it came up. I'm like, wait, what? It's like right over here.
Now, Craig, sometimes there is a limitation on the acreage. So,
that's right.
Yeah. So it depends on, when you say rural, I mean, do we live on a farm? Do we have 100 acres on the same plot as the house? Or is the house separated on a 2-acre parcel and the farm is 100? So that is to consider too when we're talking about this.
Gotcha. Because I'm 5 acres, so I qualify.
Yeah.
So if it was 15 plus, I think I'd have an issue.
I believe, that some go up to 10, some are 20.
When I spoke to CMG, their limit was 10.
Yeah. My wife's family owns 8 acres across the street, so apparently I can't own that. So, yet. I love this comment. So this is Linus, obviously. Sorry, I was paying another premium. Awesome.
You look like you're 12 in that photo, Linus.
Yeah. Who here gets excited about depositing into their banking system? Yes. We all get excited about that. It's like, I got to make another one. Yay.
I just saw everybody raising their hands. I didn't want to be left out. I didn't know what was happening.
Oh, you were paying your premium too.
Just kidding.
1,
That's awesome.
1, 2, 3, ready?
Yeah. All right. Hey, Christian. So Christian has a good question here. If I have room to catch up my policy because I have been paying just the base, can I take my weekly checks to run through my policy to get it caught up? So I want to back up on this question for a second to make sure that everybody here who's new especially understands what he's asking. So when it comes to funding an infinite banking policy through your premium deposit, whether it's monthly or annually, it doesn't really matter. But so let's just use some simple math here for Christian's example. You're putting in $1,000 per month. Of that 1,000, roughly 30% or $300 goes to base premium, which is death benefit. That's not really building you today any cash value. It helps you earn dividends, but right now it's not building cash value. The other amount of the premium, 70%, goes to paid up additions, which is what builds the cash value. Okay. Now, of the $1,000, a portion is optional. That is the PUA or paid up addition portion. That's 70%. So in reality, Christian can put in only $300 or 30% and maintain the policy, just not really building the cash value all that much. So now he's asking, if I am only putting in the 30%, can I catch up the PUAs later on down the road? And how can I do that? So anybody want to take that question?
Certainly, yeah. You can do
Yes.
that. What you're saying as far as the strategy of running your income, your entire income, your weekly checks through the policy, I would just say, be careful, be sure that you have sufficient reserves, because you're not going to be able to just turn right around. There may be like a 2-week period where the money is out of your bank account, but you're just not able to get a policy loan back yet. So just be careful you don't kind of over leverage there. And we also usually say not to use policy loans for personal expenses. So if that's what is going to end up happening here, I'd say run the math first and just be sure that it's worth paying policy loan interest to fund personal expenses, if that's what you're doing here.
I would say no. I'll make it easy. I'd say no, because you're going to be taking out, you don't have a way to repay back the system, the loan you're taking out. And so now you're paying more for everything in your life, and it's not making your policy. I mean, you'll have money go in there and it starts growing, Christian, but then what's the plan to pay it back? Right? You're better off just keeping the PUAs attached, making more money, doing the first job in Nelson's book, right? Which is make money. And the second job is banking. So make money, man. Get out there, drive, do the things that we know that you love doing, and then go ahead and start adding those PUAs back in when you're able.
So if he's just paying the base, that's
Plus,
a bill.
he's got to keep the PUA attached, plus $10, whatever.
Yeah, so if he catches up and runs all that PUA through, then he'll catch up his policy.
But he needs to take it back out because he's running money through and then taking it back out to use it.
He makes a lot of money per year. He's trying to catch up.
Yeah. So what we're saying here is that if you put money into the policy as a catch-up that you need to pay for your gas and milk, that's probably not the best idea, because now you're creating this kind of loop where you've got to pay it back, but you're putting your money into the policy. So it's just kind of a loop. But obviously, Christian understands infinite banking, by the way. So he's asking a good question just to kind of get a good question in here, I believe. But it's a great question because it comes up all the time.
So here's my question. Are we talking year 1 or year 5?
There you go. Good point.
Okay. Are we talking year 1 or year 10 when we're at 500%? See what I mean? There is not a straight answer. He's catching up his PUAs to get his policy going because he went down to base. Now he's going to run all of his money back through the PUA to get it back up to where it's normally supposed to be. Then he's going to start running it through and creating it back to where it was.
Yep. Exactly. Now, I mean, obviously down the road, different story. I mean, you're talking if you're 20 years down the road, 30 years down the road, by all means, yeah, very different story. So yeah, timing is a big one with this stuff too.
Yeah.
That was a really good point. Joe, I'd still say though, people that hear this, when they think that, hey, the goal is just to put as much money as we can into the policy, I don't know that we're setting people up for success with that thinking, right? It's really, I mean, people don't have money problems. Like, people in the United States make more than most places in the whole world. We have money patterns, and if people don't understand how to manage their money and do some of the things that you know how to do and you're teaching them, like, until they have that aha moment, oh, I got to pay myself first. It's got to go into the policy. That's where I store the money versus storing it in this account and this account and this account and this account, which is we see all the time. Right. So for Christian, I mean, he's been around this a long time, but he's also asking questions like, for that question, I would be nervous for him taking it out to use it for living expenses because he's not that far down the line. He's maybe 2 years into it, max. One. So, right. So just for everybody to hear that, it's going to be dependent on what you're doing. What are you trying to do? What are your money habits? What's your cash flow look like? And then we can kind of give you a more informed answer on what your outcome is.
And as Joe mentioned,
now, my interpretation is a little bit differently because I want to run as much money through my PUAs because I want my dividends to keep on paying me until I stop breathing. Even if I use that to pay for my groceries or to put gas in my car, I'm still making money. If I put $2,000 through my PUA and then take that $2,000 and pay that credit card, what happened to that in that situation? I just deposited $2,000 into my bank account that I'm going to be making dividends for the rest of my life, and I paid that $2,000 credit card. I know that in 3 years, in 4 years, in 5 years, I'm going to be positive. We tell everybody this is a long play. Everybody knows in the first 2 years, it's going to be the hardest part because that's where the negative is. The dividends are going to come in and they're going to upset and take down a little bit of that interest. And as that grows and keeps on going, it's going to flip totally around. In year 4, I was at 0.375%. That's how these policies grow.
Yep. And one thing
I'm
I'll
looking into the future.
Yeah. And the last thing I'll say on this one is that what we're talking about here, if this doesn't make sense, that's okay, by the way, because we're talking, this is like many steps down the road for many of you. It's many steps down the road. You don't start doing 5 steps at once. You got to take 1 step at a time. Otherwise, you're going to trip and fall.
You got to walk before you run.
Yep, this might be the 5th or 6th, but that's where learning about these things, even if you can't do it today, it's when can you do it? It gets exciting. So,
yeah, and for Joe, for this question, I actually have more questions for Joe. So, Joe, with that, because I've talked to folks that are 17, 18 years into banking, have millions of dollars in their policies, very wealthy people, right? And one of his biggest concerns is that he has a lot of outstanding loans. The amount of interest is very high per year. And the things that he's purchased with the policy loans are non-performing, right? Pieces of property, things that he owns, whatever, but they're things that don't perform. So now he's feeling really uncomfortable even though he's a multi-millionaire. But as he gets, that's his biggest concern. Every time I talk to him about banking, it's about how do I replenish my account?
And I want to ask you one question. What's the worst thing that could happen? When he dies, the policy, the death benefit pays off the loan. If he doesn't,
but I think if we're talking long term, I just want to understand your thinking on continuing to expand, because what you're talking about is you're expanding the warehouse of wealth.
Absolutely.
That way, when you make more money, as you plan on doing in the future, you have a place to store it in your system. Right. But if you're someone who's just concerned with paying off your mortgage, so you don't have that $1,500 or $1,800 bill and you're running everything through it, what happens later if you don't keep growing?
Total different person, total different scenario. But if you're the person that has the HELOC that gets 100,000 in it and throws it to an opportunity, builds up another 100 and throws it into an opportunity, and you keep on doing this. So let's say you owe $1 million to your HELOC, you owe $1 million to your policy, but you have $3 million out. Are you debt free, Jason? Absolutely. Because if that $3 million comes back in, you fill up the HELOC, you fill up the policy, and you still got $1 million in your hand.
What happens when it doesn't perform?
What happens? Well, then you should have picked a better investment.
But that's the thing. Do you see how one variable and leverage starts creating situations that can put you in, like, I've had those conversations. We've talked about it here. When I talk to someone, this banking doesn't work. Tell me about that. And then you find out that they put money they had stored in a policy and they went out and made multiple things. And now the things are non-performing. They're not coming back and they might never come back. And now they're really in a bad position trying to repay policy loans, keep premiums going and other things. So I'm just saying, when you're going through this, not a get rich quick scheme, you have to really understand what you're doing and make sure that you're getting guided.
I've been a private money lender for 13 years. I don't know if anybody's been a private money lender for 13 years here. I have not lost 100% of any of my investments yet. Yes, there are some that haven't paid in over a year. There are some that haven't paid in 2 years, but guess what? It's still going to come in. Even the ones that are really bad, it just takes a little bit longer to come back. But I, knock on wood, still good.
So I guess to recap, if we could recap on everything, Christian, you talked about room in your policy, call your insurance company, see actually what the numbers are, right? We're all about numbers here. Figure out what that number is. Hey, do I have extra money that is sitting around? You talked about weekly, getting money weekly, right? How much is that number? And or do you need money to eat? And then you need money to obviously put into a storage vehicle. But you want to make sure that the things that you have for daily life is a little bit to the side that you use for daily life versus this excess, extra savings, storage, right? Things that you can use for opportunities, emergency fund, anything that you can think of, right? That you're planning on using in the future. That's where you're going to want to put that extra money.
All right, let's try to dive into some of these other questions we got. So here's another one from Dave again, Maverick Dave. call them that. But so regarding the HEI, would the vault, so our vault software, would that help figure out if using the equity would be beneficial for investments in conjunction with infinite banking? Individual has a lot of equity, however, debt to income is off. Yes, it would. I mean, it's going to help with that, but I think you might need some guidance, or they may need some guidance on top of just using the vault. So we have our crack in the vault tomorrow, but I think that's.
I think if you're part of the vault family.
Yeah, that you get to attend the meeting. I think we.
Oh, Brian's frozen.
He's frozen.
Subscription model. So if you're a subscriber to the vault, a member of the vault, then
he's
that
back.
training.
He's back.
Yeah. So I did. Yeah. So I didn't hear what you were saying, Jason. Where are we going? What were you saying?
No, I was just saying that to be part of the vault training tomorrow night with Craig and Marius, you have to be a subscriber to the vault. That's all.
Yep. Yeah. So definitely check that out, and then definitely schedule a call with one of us, and we can see how it works, because you can put in any kind of loan or debt inside there and have it run scenarios depending on what the outcome is that you're trying to accomplish. So Craig has a question here. Do you think the new FinCEN rules will hurt private money lending and borrowing other than more paperwork? Do you think it'll discourage anyone? So I don't really know. I haven't looked into it. Anybody else look into that?
Yeah, I don't know about the new rules.
I'm just looking at it right now. Just
I've
says,
looked, it's come up before. I just don't remember what it is.
It's to do with, I don't know a lot. I read about it the other day, but it's more, when you're using a trust, a LLC, different things, there's more paperwork involved. My immediate thought just reading, and by the way, I'm not a private money lender yet. So just giving you my take on the article, I think it'll get people that aren't doing this with due diligence out, perhaps, and maybe you're going to have more detail oriented, more information when you're making these moves. I don't know if that's true, but that was part of what I kind of thought when I read it.
What I would say is this: it makes the honest people honest. Oh wait, they're already honest, so they are. It makes the ones that are not so dishonest or trying to squeak through a lot harder to do that. That's what it does.
The new rules he's talking about is where all real estate transactions have to be reported to FinCEN if it's a cash transaction. It's not being financed by a bank.
Yes.
And so it just becomes all of a sudden a big, like, shoot, why do we need to do this? And I think the same way is like, it's like punishing the good guys to try and catch the bad guys, and it never works. They've been trying this forever.
Kind of like gun rules. I'll get into that. But I've come across, we won't get into that whole big ball of, whatever. But I will say this.
Started it.
Yeah. I have come across money laundering while doing infinite banking, trying to do it for other people. I've come across money laundering.
I have too.
So it is out there. And so all they're doing is trying to address that with more rules and regulations to make it more automated, in my opinion. It makes it harder for the honest people, but at the same time, are there enough bad apples that are causing problems to make it worth it? I don't know. But that's I think their standpoint or viewpoint.
And it's always a bad guy that creates a new rule that we have to adhere to.
Or a politician. Oh, wait, that's a bad guy. We'll get into that. All right. Anthony's got a good question here. For someone starting a policy at age 69 who's looking to build gains and wealth sooner and knows that death benefit might be less, are 75-25 and 90-10 overall better than a 65-35 or 60-40? That's actually, it depends. It depends. In most cases, I would say yes, generally speaking, not specific situation focused. But I will say a lot of the older policies on older people, not older policies, that, I'm seeing the higher ratios. But more importantly, it's the amount going in at the beginning. If you're trying to catch up, it's the big dump-ins. That's where the power is going to be when you're at that age, by the way, is getting as much PUAs in as quickly as possible, because we don't have, just being honest here, 30 years for that compounding to come into play. So you want that compounding to happen earlier. So larger PUAs, which are dump-ins, you see a lot. So I don't know if anybody else has any comments on that one.
No, it's just going to be depending on where you live, who we can write with, what the cost of that term is going to be, what makes sense. Because, when you're older, like having less going towards the base is going to increase the cost of term and things as well. So it kind of depends on what you're trying to do, what it needs to look like. And that's why it has to be special engineered. So.
Yeah. not sure what this comment. This is the CMG in the bank. So yeah, so we already went through this one, the rural thing. Yeah. So yeah. All right. So Roy, you got a few questions here, and I like these questions. So I want to go through these in one at a time. So you say, I have a policy that is coming up on its 3rd anniversary. So awesome that you have one for that long. I love that. On November 6th, the guaranteed cash value is starting to grow when I put PUA in now. Is this the compound interest starting to scale? This is an awesome question, by the way. An awesome question. So I'll let someone else take this one because otherwise I'll get too excited.
I'm going to say not necessarily. I believe what you're looking at is a couple of different cash values. And what that company is calling guaranteed cash value is actually just the cash value generated by the base portion of the policy. You'll see a different number for PUA cash value and cash value generated by dividends, like 3 different buckets and maybe even a 4th one. So the guaranteed cash value that you're seeing that's only now starting to come up is probably just that base cash value itself.
Yes. So I'll just do a quick little example here. You guys can see this.
There you go.
So what he's referring to is you'll see on this thing, there's a guaranteed number on the left-hand side over here. Ooh, I can do a laser pointer. Sweet.
Yeah.
Right
What's different there is that's including the guaranteed cash value from PUAs as well. That's why it's not just 0 in year 1.
Yep. This has a big dump, and so keep that in mind. I probably have other examples here. See if I have any that have zeros. Oh, sorry. This is so Linus, this is Lafayette. They don't show it that way. They're a bit different, I think, right?
Yeah, my point exactly.
Yeah, so this one doesn't show the zeros, but yeah, so in this one, you'll see a guaranteed side and a non-guaranteed side. So for I think it's Roy, we tend to focus on the non-guaranteed side, not the guaranteed side, because it's nice that it's there, by the way, but the non-guaranteed, which is the dividend side, is what they've always paid, historically speaking, for 100 plus years. So we tend to focus on this side, which is going to have the higher cash value and have, in your situation, by the way, have cash value right off the bat, not 3 years down the road. It'll have it immediately. So that's a good question, though. So let's see, what else is he saying here? So yes, you're correct. Now there's a second part of his question here that I want to make sure we go through. Where to go? Okay, here we go. Now so this is what he's saying. He goes, now when I put in a paid up addition or PUAs into my policy, I put in 530 of paid up addition and net 500. And my guaranteed cash value will grow a little under $100 each time. So does anybody else understand that? I'm not quite sure.
No, I don't. I mean, usually when you're putting PUAs in, unless even with a table rating, it'd be a lot more than that. Like you're going to have high cash value, for the policies we have, the 5 we have, every extra $100 I put in, $94 goes to cash value because there's a load on it. Like if you have a high table rating, you might put in $100 and you might get $82, right? Because of the load. That's just the cost and risk to the insurance company for the death benefit and other costs, right, to run the business. So that doesn't make sense to me, Brian.
When he's saying his guaranteed cash value grows a little under $100 each time, that's the base cash value.
Yes.
It's kind of misleading that they say guaranteed cash value because that amount you're netting from the PUA is also a guaranteed cash value, but it's guaranteed PUA cash value, not base cash value. So the a little under 100 he's talking about is specifically base cash value.
Yeah. So Roy, if you're still on, knowing like what your total amount is going in, and what percentage of that is PUAs is important. And what insurance company are you with is also very important. So we don't know the policy you're talking about, who built it, nothing about us. We're kind of just guessing a little bit. But on the screen here, if you guys can see this is a premium of $1,050 per month. You can see it right there. 400 is base premium. So Roy, that's the portion you're referring to, I think is base would be this portion. And then you've got this PUA portion of $527 going to PUAs. But the total premium here is a little over $1,000. So just trying to understand exactly what you're referring to in that example. And by the way, the example on the screen here, this is that's a big dump, and that's why. So there you go. We need some more information to kind of understand that one a bit. Yeah. Okay, so we got some questions here to get through. Let's see here. So Derek says, if intentional. So I think he's referring to how you're running your money through the policy for your general expenses. Your policy is a captured ledger of every penny you put in. That's kind of an interesting way to say that. Even if you take the money loan back out, the idea is to catch it up with it later, or eventually you can lose your PUA, be the bank. Yeah, Derek. Yeah, what you're kind of talking about is what we already went through a little bit. But yeah, you've just got to be very careful about, hey, I'll do this today and then catch it back up later, or I'll borrow it out and I'll just pay it back later. You've got to be very careful about that, because oftentimes that kicking the can down the road keeps getting kicked. Yeah, if you keep kicking it, then eventually, guess what? That can's going to get heavier and heavier and heavier until you can't kick it anymore, because now it's full of rocks and you'll break your foot or break your policy. That's my analogy right there.
This goes back to the habits versus patterns, right? It's
100%.
Right.
Yeah. That's what I was going with that. Yeah, because if you pattern is doing that, then
which is why I wanted to have a longer discussion with Joe, because I know what Joe's saying. A lot of people know what Joe's saying, but I also feel like there's different parts of the journey, and how people hear it is going to be different based on their knowledge level.
Well, what I say doesn't work for everybody. That's why everybody is different. There is no black and white answer to any of these questions.
But Joe, we love you so much, and you're so likable. Everyone just wants to do what Joe's doing. Who doesn't want to have their home paid off 10 times?
Yeah.
What I'm saying, I must be doing something right.
There you go.
Yeah. I want to show this one here real quick. So Linda, we were talking about, so this one, here's one that shows zero. So this is a different insurance company. They show it kind of the correct way. So it shows zero right there at year one. Even though they put in a big dump in, zero cash value on the guaranteed side year one. On the non-guaranteed side, $49,000. So that's why we tend to focus on the right-hand side.
But you just skip the other column there. You see cash value zero, and then you say PUA cash value.
Yeah.
The number there. That's the two different cash values I was talking about.
Yes.
Yeah. And so the thing is here, that one right there. This one here is saying that if you do not put in the optional portion of the premium, only the part you have to put in, that's your cash value. PUAs are optional. So this here is assuming, you didn't put in any PUAs because they're optional. That's what your cash value would be zero. So yeah, good point. Okay, so this is a good question here, kind of in the same vein. So why should we pay additional PUAs just to borrow the same amount back out? Is it because it increases the size of our bucket, which ultimately brings in more dividends? Yes, you answered your own question, by the way, which is awesome. This is me. Is that you?
The big thing I like about PUA premiums as well is that it's buying you a permanent paid up death benefit. Paid up meaning fully paid for. You never pay for it again. It's not like traditional policies where you're paying on and on monthly or annually. It's a one-time payment in exchange for an immediate guaranteed fully paid up death benefit. And since it's fully paid up, it immediately has a high equity already. That's why you're going to see a high percentage of cash value available right away. And then it also earns dividends.
Yeah.
It's a way to expand your banking system if you know that you have things that are money flowing in, windfalls. Like it's kind of Nelson's 6 rule is have a place to put your windfalls. And so think a paid up addition, just to make it super simple. Like if this is your original contract, when you have a dividend by a paid up addition, or you add a paid up addition, it's just adding like a carbon copy of that contract. And those things keep stacking. It's paid up and it's an addition to, per what Linus just said. Like that was perfect, but just so you can see it, you're just stacking paper on top of the paper that you already have.
So now correct me if I'm wrong. Is this question not the same as Christian's question? This one got a yes and that one got a no.
Well,
it wasn't a yes or no. I know Christian personally too. You know that I've had multiple hours of conversation with him. So, I know patterns. So that's why.
You didn't buy a truck though.
Exactly.
I did.
Back to our favorite word. It depends.
Depends.
It depends.
This question was just saying, why would you do it? Why would you expand your system? Like why, like for instance, like I have a policy for my oldest, for Diego, that it's all base plus $10. Like if you saw it in an illustration, like if I was showing that to someone going through the process of wanting to be their own bank, they think it's the worst thing ever. But I wrote it with a carrier where I can go up to an additional 18,000 of paid up addition per year into that policy as long as I keep paying the $10 a month, because I don't know how much he's going to earn. I don't know what his job title is going to be. There's a lot of unknowns. So I want a nice big container with a manageable floor.
Which is awesome.
Yeah.
Right.
So that's why that would be like, if that was Diego asking that question, then you would want to buy additional PUAs because that situation would fit it, right? It depends.
Yeah. Yep. Yeah. And also this is me. This is that you? I love that name though. But it's just, by the way, it's also just math. I mean, so when it makes sense to you, it makes sense. And so I love asking the question, even if it makes sense to you, because other people, it might not make sense. But for those of you that it doesn't make sense to, it's just knowledge. Once you understand how the infinite banking concept works, because it is a concept of how to flow money, then they'll make a lot of sense to do certain things versus other things. Yeah. 808 for life. That's kind of an interesting name. So how do I best utilize my HELOC or home equity line and policy once I pay off my current debt? That's the question. Then use them as my future banking system as opposed to traditional banking. So yes, so this person also did the same thing that the other person just did. You answered your question correctly, which is awesome. So once you're done with the HELOC, once you're done paying off your current debt, and you have a policy with cash value and a HELOC with zero bounce on it, that's awesome. As Joe would say, that's when you put your money to work. You really start putting it to work. And you can also replace traditional banking with your banking, such as buying a car, paying for college, paying for a wedding. You can do those things and also put that money to work. So, I mean, literally, it's your imagination, So
get some assets, buy some assets, right? Get something working for you.
Yeah, that's really kind of where it goes.
Make money while you're sleeping, right? Yep. That's the goal. So then
you're going to do the one pot system. There isn't a difference between the policy and a HELOC. I operate it as one with my system. The money comes into the HELOC, runs through the policy, back into the HELOC, throw it out, make more cash flow. What's king? Cash flow is king.
Yep. It's kind of funny. People always say assets. I don't use the word assets. I use, I'll say like a cash flow and asset, or asset cash flow.
I was thinking about it. What you're going to say, cash flow and assets.
Cash.
I like assets. Cash flow assets. Because there's lots of assets, but not all of them cash flow. Like Jason, you had a client that had the same thing. They're not cash flowing. It's an asset, yes, but is it a cash flowing asset? That's why I use the term, asset cash flow. So, but I made that mistake.
Say that quick 3 times.
Yeah, I'll probably say something different. Not appropriate. All right. So, any questions here? We got. Oh, this one's an interesting one. This is the follow-up to the one about the FinCEN rules. Yeah, so like the AML rules, which I loved when that came through. Oh my gosh, that destroyed me. But yeah, just adding more fees at closing time. That's awesome. Got to love more fees, right? Yeah, that's anti-money laundering is what he's referring to there. Yeah. Well, I think that actually might be all the questions.
Problem charging all. Go ahead.
What's that? Oh,
I was saying, do you see the problem charging all the good guys just in order to try to catch the bad guys? I mean, it's like, yeah, you're loading all this on everybody else's back.
What it does, it stops them from coming to us and has them go somewhere else. I have no idea where that is though. That's what happens. Kind of scary. All right, hey Damien, how you doing? I think he's in Spain right now at a mastermind or something. That's awesome, man. Nice. Says, if you have a UPS address or store address, can you operate from overseas? I did this while working as a merchant mariner.
Oh, he says he actually did do that.
You can. It depends on what you mean by that. So, when it comes to a policy, by the way, for everybody else listening, you have to reside in the U.S. and be paying taxes here. Essentially, doesn't mean you got to be a citizen, but you got to have there's certain things you got to abide by. Now, if you're overseas, they don't like that. Now, if you get a policy and then go overseas, typically nothing's going to happen because it's locked in. But if you're overseas trying to get a policy, the answer in most cases is no, that won't work. You've got to be in the U.S. You have to have an address here, all that kind of stuff to get a policy here. I do have clients that are not in the U.S. though.
You can be living abroad for a certain amount of time per year on average and still be qualified, but it also depends what kind of countries you're spending time in.
Yeah, Nigeria, no. Iraq, no. Iran, probably no, I'm going to guess. Venezuela, no, by the way, as well. What's the other country?
Nicaragua.
Yeah, that's a big no there. And by the way, I say this because I've had denials from these countries because people traveling there for military. But yeah, but good question though. But it's all dependent though. I do have clients that reside outside the U.S., but they got a policy. All right, so Tori Sue, I think I'm pronouncing that right, says, if I have a 10K HELOC, so home equity line of credit, is it more beneficial to pull all 10,000 or put all 10,000 from the HELOC towards the mortgage, or 1,000 a month for 10 months prepaid?
How much is the interest rate on the mortgage? How much is the interest rate on the HELOC? Not enough questions. It depends.
Yeah.
Hey,
The
Joe,
thing is mathematical.
is it math?
It's math.
Yeah.
Yeah, so it's a math question. So it could be a yes or no. It just depends on the math. So this is the fun thing about what this kind of stuff does is just do what the math tells you. That'll be the most efficient way.
Do we have any credit cards? Do we have any car loans? Are there any other debts? What is our cash flow? I don't know. Call me. We'll figure it out.
Yeah. So Damien, to follow up with his question about, by the way, the overseas thing. Obviously he's American. We know that. He's deployed, by the way. He has policies. He works, obviously overseas. But yeah, you have to have a bank account in the U.S. to run the money through and all that kind of stuff. But here's the thing that's come up quite a bit. A military base or what's the other things that are considered U.S. soil? What?
Embassies.
They're not, yeah, they don't count, by the way. So yeah, we're going to do the medical and the application have to be done on U.S. soil and your state of residency as well, by the way, in most cases. Yeah, typically there's no exceptions. And even like someone said, well, what if I go to the Navy ship and out in the middle of the ocean? No. Doesn't count. Yeah, they're not going to be doing that. And then 808, another follow-up says, one pot my system. To make it a one pot system, do I need to work with Joe and the Real Money Masters, or can this be organized through TMM BYOB? So just by the way, so Real Money Masters, TM, we're all in the same team, by the way, just different, groups. We're all in the same team, by the way. So obviously Joe's team does focus a lot on the one pot system, HELOCs, all that kind of stuff, which is velocity banking as well. But obviously we have a lot of clients that do this outside of us, but you can also do it with us as well. It's up to you, but I definitely would recommend, if you're part of this group, just talk to Jonah's team. I mean,
I've only been doing it for 17 years. I'm just trying to get the hang of it now.
and next week it'll be 20 years, by the way.
Can't do that.
Oh.
Can't do that.
No,
09. What's 09 and 26? Isn't that 17?
Yeah. Oh, and so this is a great one. So Dexter brought this one up. Puerto Rico beach is U.S. soil. Technically, yes, it is. But can you do this?
Yeah, you can.
You can do it.
Puerto Rico and a couple other U.S. territories now.
But it has. But the companies are specific about whether or not you can do the medical in Puerto Rico.
No, they don't care where the medical is done. You can do the medical in any state, including U.S. territories, as long as the medical company operates there, which they do. But not all companies write policies in, say, Puerto Rico. It may need to be done in some other state where they do business, but some of them do.
Yeah. So there's one of the ones we use, one of the main ones. They told me no, they will not do it in Puerto Rico unless they came to the States to do the medical. I'll have to look at what company that was, but yeah, you get conflicting information sometimes because they don't. But to be honest, there's not a lot of cases in Puerto Rico with the insurance companies. It's very rare. But yeah, they have different regulations for them. And then I'll put in Joe's email into the chat box here in just a second, and that'll get you guys in touch with him if you want to talk to him. Or I'll put in the our calling for our Money Mentors too. So as always, we went a bit over time. So here is Joe's email in the chat box. And then I'm going to put another one here with our call link. So if you guys want to schedule a call with us, and thanks for Linus for always doing that for me, so I know what the link is. I don't know why I can't save it, but whatever. Yeah, so we got through all the questions. Any last minute questions? Any comments? Anybody?
Awesome questions today.
Yep.
Come back next week and ask more.
Yep.
Go.
Bring a
Same
friend.
bat time, same bat place.
It will probably say it depends a lot.
Yeah. Yeah, but appreciate everybody, appreciate all the questions. And also definitely go ahead and check out chrisnoggle.com. We do have a virtual event coming up here in a bit, end of this month, I believe it is. Definitely recommend you guys check that out. It is a packed full of knowledge and information, speakers, and all that kind of stuff. Think of it like this, but a lot deeper dive into different strategies, different concepts outside of infinite banking, but that work with infinite banking. So if you want to level up your wealth, level up your financial situation, level up your knowledge first. That's first and foremost. Go level up your knowledge, and that is a great place to do it in this virtual event. We just did one here, I think, a couple months ago. It was awesome. So yeah, definitely check that out. All right. So with that, appreciate everybody, and with that, we will see you all next week.
Bye-bye.